Would you like to hear something slightly ridiculous? And not only ridiculous, but also something that may suggest a rather large company is in trouble, but where you could also make a profit. The ridiculous thing we're looking at today is the proposed takeover of Shutterstock by Getty Images. Getty Images, founded by Mark Getty, son of oil billionaire John Paul Getty, and now valued at slightly more than $1 billion, has reached an agreement to buy smaller rival Shutterstock, a company founded in 2003, and also boasting a market capitalization of approximately $1 billion. The ridiculous thing about this proposed takeover is the method of the transaction, and an interesting detail could suggest financial troubles for these companies. You see, shareholders of Shutterstock have been offered three possible exchange mechanisms should they approve the takeover by Getty. The first is for Shutterstock shareholders to receive $28.85 in cash. The second allows Shutterstock shareholders to receive $9.50 in cash plus 9.17 shares of Getty for each Shutterstock share. And the third option allows shareholders to receive 13.67 shares of Getty Images for each Shutterstock share they own. So far, so simple. It isn't wildly unusual for an acquiring company to offer different exchange mechanisms to the selling shareholders. What is unusual is for the different options to provide wildly different returns for selling shareholders. Ordinarily, if there are two or more options for selling shareholders, the value of each will be very, very similar to the other options. When we work through the numbers in this deal, we can see just what an investor could expect to earn. The current market price of Shutterstock is $30.67, and should you decide to buy these shares to arbitrage the deal, you can expect a loss of 4.96%, or a loss of 12.93% on an annualized basis. That's right, the spot price for Shutterstock shares is higher than Getty is willing to pay in cash for the company. If we move to the second option, taking some cash and some shares in Getty results in an expected return of 11.19%, or 29.18% on an annualized basis. The third option, that is selling each Shutterstock share for 13.67 shares in Getty, the arbitrageur can now expect to receive a return of 19.12%, or 49.85% on an annualized basis. Here, you simply take a long position in Shutterstock, short the equivalent shares in Getty, and wait for the transaction to close, at which point your positions will cancel out and you'll be left with a healthy return, and even a dividend payment on the Shutterstock holding. So, at today's prices, you can buy shares in Shutterstock, and should the takeover go ahead, you will earn a return of negative 4.96%, or 11.19%, or 19.12%, depending on which you prefer. This is obviously slightly mad. Why would anyone take a lower offer when a higher one, which appears to be essentially identical, is available? This brings us back to the beginning of the video. It's possible these companies are in less than optimal financial health. The eagle-eyed among you will no doubt have noticed that the two offers that include a cash element have the lowest expected return, and the highest return comes from the all-share transaction. This is obviously designed intentionally to nudge investors to accept the all-share deal, and the outcome of that is Getty won't have to make a cash payment to buy their competitor. The question, therefore, is, if Getty Images is struggling to get $1 billion in cash to buy their rival, are they themselves in trouble? It is possible, with the advent of AI and the ability for people to generate images by typing a simple prompt, that Getty and Shutterstock have both seen the writing on the wall. If they are able to combine in an all-share transaction, possibly they will be able to stay solvent long enough to figure out how to survive in the world of AI. If they remain independent or spend cash on the merger, their time could be up before they are able to figure out how to compete in the new world. An enterprising investor who had conviction that the deal will close, which isn't certain at this stage, could easily take a long position in Shutterstock, short Getty Images, and make a risk-free return of 19%. However, I suspect this probably isn't a company to hold for the long term. What do you think about this deal? Is it a merger of desperation from two companies that are struggling to survive in the AI world? Will the companies find a way to compete? Are you brave enough to take a position in these companies? Let me know in the comments. And please don't forget, all the figures mentioned are at the date of my calculations and will change in line with the share price, any changes to the deal terms, and the duration to close. As always, this information is provided for educational purposes only. You should not consider anything in this video to be investment or financial advice, nor a recommendation or endorsement to buy or sell any financial instrument. You should always conduct your own research before considering any investment and seek independent financial advice. Well, that's it for today. Thank you for watching, and I hope you'll join me again next time.